Hey everyone, Chris Haddon here with REI Networks with another very, very cool expert interview. Today we are talking to attorney Kimberly Mann, a securities and funds attorney here in the DC area. Kim, thanks for being with us.
Hi, Chris. Glad to be here.
Absolutely. No, this stuff comes up all the time. And I definitely want you to weigh in on a number of things related to the legal considerations when raising capital for real estate acquisitions, other sorts of real estate deals. And we've talked about some of these deals ourselves that like we've actually been involved in that debt and equity blends and preferred returns, and we're going to dive into some of that stuff. As we get started, if you wouldn't mind, could you give a little background for everyone watching?
Sure, sure. So I'm a shareholder at Shulman Rogers. I co-lead the fund formation practice. I've been doing funds work for more than 20 years, not at Shulman Rogers, but at Shulman and at another firm. And I represent all kinds of funds, real estate funds, private equity funds, venture funds, other types of alternative funds, even timber funds. And I also represent some investors in connection with their investments in funds. So a lot of work in the funds world.
Very cool. Very, very applicable to what we're talking about. In case people don't know, Kim's firm is the law firm here in the DC area that we've worked with for many years for a number of different things, for loan documents or other business legal stuff like operating agreements and you name it. And it's been a long time and a very good relationship. So yeah, again, I appreciate you being here and speaking to our members.
Happy to do it.
Absolutely. Okay. So most of our people, business associates, members of REI Networks, they're involved in some kind of real estate acquisitions, mainly multifamily. Let's talk specifically about multifamily, maybe office. I know self-storage is popular. What is the most common fund setup for acquisitions like that when sponsors are raising a good amount of the capital?
Yeah. So the traditional fund structure is, in my experience, the most frequently used, although a lot of fund sponsors still use single SPVs, and they might do a number of deals in SPVs. Sponsors, for the most part, do one commingled fund and have all of their deals invested through the fund.
Okay, let's break that down. So am I correct that SPV is a special purpose vehicle?
That's correct. Right? It's a special purpose vehicle. It's an entity that's set up for the sole purpose of making an acquisition, making an investment.
Of one deal.
One deal.
Right. Okay, so that's what we've been involved in. And we'll talk about like the business and financial part of it here in the near future, but that's more of what we've seen in terms of you have a sponsor, they make a business entity for this particular acquisition, and they're going to raise, I don't know, we don't have to throw a dollar figure on it, but the majority of the capital required to do the deal. And then they will put in a certain amount themselves. And that's typically how it goes. But that's usually what I've seen, a special purpose vehicle or a single entity for that deal. What kind of documentation goes into a structure like that? And then we'll talk about the opposite.
Right. So that's, the documentation that goes into the establishment of a special purpose vehicle is very similar to what you would use for a fund. There's an operating agreement if it's an LLC or a partnership agreement. There may be a subscription agreement to sign up all the investors to the SPV. There may not be the same level of disclosure in an offering memorandum, for example, but there might be some offering memorandum. There might be risk factors included and something about the business case, but it's generally the same types of documents that you would see in a fund, just on a smaller scale.
Okay, that makes sense. And then the other way, and I'm guessing that might be for larger firms that do multiple deals and even acquisitions all at once. The other setup would be a similar sort of fund structure, but they're going to be making 5, 10, a dozen acquisitions through that one fund.
That's right. So they've got a devoted pool of capital, and they can deploy it in accordance with their strategy, whatever they've disclosed their strategy to be, and they can make multiple deals with the same group of investors. So they're not going out multiple times to get investors for each deal, and that's one of the advantages of doing a deal in that way. A fund also can own a special purpose vehicle. So the fund might establish its own series of special purpose vehicles for each deal, but it's still got encapsulated within the fund its own pool of capital.
That makes sense. I could see that being a handy way of doing it.
Yes, and one of the principal reasons for doing it that way is that you're putting at risk only a single asset. So if someone were to sue you, if something goes wrong in a development deal, for example, you've only put at risk one particular asset rather than the whole pool of assets that the fund owns.
Okay, that does make sense. So in either of these setups, like the full-on fund versus the single purpose, special purpose, do the investors have to be accredited?
Depending on the fund and depending on the exemption that the fund is relying on. So if the fund is a so-called 506B, as in boy, fund, it can have up to 35 non-accredited investors. If it's a so-called 506C fund, which permits general advertising or general solicitation, like on YouTube, or just calling people out of the blue to invest in the vehicle or the fund, all of those investors have to be accredited investors. So that's the difference. Just one word, Chris, about accredited investors. I often get questions about whether people should permit investors that are not accredited. They've got friends, they've got family, and then they might just want to increase the pool of investors that they include in their deals.
Sure.
And even if you're able to include them, you have to think about the sophistication of the investor, whether they have the financial wherewithal to risk the capital, and whether they really understand the investment. And so it's really great to democratize these investments, but it's important really to understand the risk of including people who may not have the wherewithal financially to participate.
Yeah, we've run into that in the past too. In our 12 plus years of raising capital for lending primarily, is that we always shied away from people who we got the sense they truly didn't understand what it is we do.
Right. And that's dangerous.
It is. It could be.
And them.
Yeah, absolutely. And even if they're legally allowed to invest with us, there's still a certain amount of liability or maybe just best practices to be aware of in that regard.
That's right.
Okay. So I know that a lot of people that we talk to who are doing the office and multifamily and self-storage and stuff like that, when it comes to doing multiple deals that might result in multiple funds or special purpose vehicles, everyone's worried about cost, right? Like we're not Blackstone. Right? The people we do business with aren't Blackstone. Right. And we don't have in-house legal teams and all of that stuff. Is it possible after doing the original formation of a fund to, in essence, use that in a lower cost manner for additional deals?
Sure, absolutely. And that's why we encourage people to spend a little more on the front end, because then you've got what you need to adapt it to other funds. And so it can grow as you grow. And so you can certainly do that, but you have to know what changes and what doesn't change, because as the deal changes, then the disclosure might change and the terms might change. So it may not be exactly the same document, but you can certainly use that as a good basis for the next fund. Okay. And the funds after that.
No, that's good to hear. That's good to hear. Everyone's always worried about costs and hits the bottom line, right?
That's right. It's an important consideration, and that's what keeps a lot of people from forming a fund in the first place. It's the money. It can be costly, and the administration is a little bit of a burden too. But But in the end, I think it's the most efficient way to go.
Got it. Good to know. All right, let's talk about some money. Let's talk about the financial aspects like debt versus equity. In deals that we've done, there was in essence, a blend. I mean, you might call it equity with a preferred return. So you might get 10% annual on the money you've invested. Plus there's going to be equity based on your ownership in that entity when there's cash flow above that return. Is that the most common scenario for a lot of these real estate acquisitions?
That is a common structure that we see. They really run the gamut. After a certain return, the carry gets higher. The carry recipient can get more after the investors reach some threshold, some milestone. They really run the gamut. It's no longer a one size fits all. It really just depends. One thing about leverage, investors can be a little weary of leverage. There's a certain amount of equity that the fund invests, and then it takes on debt after that. Particularly larger investors, more savvy investors, scrutinize the level of debt pretty heavily, especially if it's a first-time investment for them. So that's something to consider too, the level of debt that the fund takes on.
Now, would that be debt in a real estate scenario of the normal kind of mortgage debt that
Yes.
this acquisition? It wouldn't be leveraging the capital in the fund, not that kind of debt.
That's right.
Okay.
It's acquisition debt.
Okay, so you're
That's right.
70% of the acquisition price, and then you have your 30 coming from the cash and all that.
That's right.
Understood. Okay. Something else related to the investment type and how people are being paid. So I know that just from talking to people in the industry, oftentimes they want to raise debt. They want to pay, they don't want to give up too much ownership or any, and they want to do this using, I don't know, unsecured notes at 10%. Is that problematic in any way? Is it common and normal? What's your opinion on that?
Yeah, so debt funds have become a lot more popular in the last several years. And so it's really not a lot different. I mean, the risk profile might be different from a business perspective, but from a legal perspective, there's not really any difference. It's still a security. The same laws and rules apply. It's just a different type of security, but those are really popular.
Is that right? More popular
Yeah.
than they have been in the past?
They are increasing in popularity. Debt funds, we get a lot of inquiries about debt funds. We see a lot of investors investing in debt funds. If you look at real estate platforms, you see a lot of debt instruments out there. Yeah,
And
that's pretty popular.
do you think the increase in popularity of debt funds might be due to the market doing so well in past years and people are willing to get in on different stuff?
Yes. And so when things go south, you'll see a totally different appetite for debt funds. But right now, things are good. Debt funds can be popular when there are credit disparities. When there are issues in the credit markets, debt funds can be popular because businesses can't find other sources for lending, for borrowing. They also can be popular when people are just looking for, sources of return. But when things go south, it'll be different.
Yeah,
Much less popular.
Yeah, there's just so much capital in the market now. I think that sponsors can, they just have more say. They just have more say in what they're willing to pay, and people need to deploy money. When there's liquidity, people need deals. And you're right. Like when the market changes, that'll be a different story for sure.
Right.
Okay. I'm going to throw out a few questions that have popped in my mind as we were talking. What are some of the mistakes that you've seen real estate sponsors make in relation to what we're discussing?
Right. So one of the principal mistakes that I've seen real estate sponsors make is to assume that because they invest in real estate, that they are not subject to the securities laws. And that is a big mistake because although they may technically be indirectly investing in bricks and mortar or dirt, the way that they're structuring their investments may make them subject to the securities laws because they may be doing it, for example, through a joint venture. And they may be a minority stakeholder, or they may be the controlling stakeholder. And therefore, they may have a security, and they may be managing a security. And those securities laws may apply. So that's not a good assumption. That's one of the biggest mistakes I've seen people make.
Yeah, I could see that. But I would also guess that a lot of people fly under the radar in that regard, because maybe they have 10 or 12 investors they go to each time for each deal. Everybody's fine. It's not like a big, widely advertised, like funderized sort of situation. So I'm sure there are a lot of sponsors flying under the radar in that kind of setup.
That's right. There are an awful lot of sponsors flying under the radar, and hopefully they will continue to be under the radar. But one never knows when something could blow up and a regulator might come in. Not likely. I mean, the risk is fairly low until it happens to you. So just something to keep in mind. If something goes bad, an investor may decide to talk to somebody, some regulator about it, and somebody comes knocking on the door and asking questions and looking at docs. So
sure. Yeah, I mean, I think it's just really important for the members of our group to be aware, to just start by being aware of what they're getting into, who they need to speak to about it, how big they're going to get. It might be, yeah. I mean, I honestly do think, like, depending on how big you're going to get can drive some of these decisions. Is it a one-time deal? Do you plan on, acquiring 5, 6, 8 good sized projects a year and raising tons of money? Because in that case, like, you do need to invest more in stuff like legal and accounting, right, and a lot of the heavy lifting up front that's going to continue to benefit you for many deals and many years.
That's right. It's just infrastructure. It's part of your infrastructure. And part of forming and raising a fund is really just stepping back and analyzing it. What do I need? What am I doing? Am I doing just a few small deals? Who are my investors? Are they, just friends and people that I've invested with all along? It's just good to think through the issues, just to make sure. It could be just a matter of restructuring or, thinking differently about the structure that could put you outside of the scope of the securities laws. So it is good to invest in that.
Okay. Are there any other sorts of structures related to raising capital that I missed? Any other common ones that I did not?
Yeah, I don't know that we talked a lot about joint ventures. That's one big in real estate. See a lot of joint ventures. But those are the typical ones: credit funds, SPVs, normal commingled funds, and joint ventures are the big ones that we see.
What is a quick breakdown of what a joint venture looks like?
So a joint venture, think of it like a co-investment, right? So, you've got two players coming together. It could be one that has a lot of real estate experience, a real estate fund, and one that's just a venture, a financial venturer, just putting in the cash, right? So then you've got a case where the real estate fund is actually just running the whole venture. They're selecting the investments, they're, putting the capital to work. They may have subsidiaries that actually do the building or, whatever the case may be. And then you might have a joint venture, a different type of joint venture where you've got equal partners, both participants in the actual business. So those are two kind of extreme examples of what a joint venture would look like. Those documents are quite different from a fund agreement.
Is that right? Okay. Yeah, I hadn't come across that before. I guess that would happen mainly if you have a source of capital with very deep pockets, like maybe a family office or something like that, and they're going to team up with a sponsor to do many deals over many years, but from one source.
Right. That's right.
Got it. Right. That does make sense. Yeah, we never wanted to put that many eggs in one basket.
That's smart.
Yeah, like we never wanted to have for the capital that we have for our lending company, and never wanted to put any more than 20% with one source, one group, because, and no one has, thankfully things have been good. But if somebody backs out, you're gonna, right?
It's a bad situation.
It's a bad situation.
Situation.
Yeah, if you're getting 50% or maybe even 100% all from one source, to be very wary about that from a business perspective. But that being said, it's very doable legally.
That's right. That's right. And, it's a stable source of cash. If the joint venture partner is reputable, they're not going to risk their reputation. But then again, if they're a big source of your capital, they have a lot of control. They have a lot of say. So.
That they would.
Yeah.
Well, very cool. Again, I thank you for taking the time and being with us and breaking some of this stuff down for the members of our real estate group. And if anyone wants to reach out, we'll post all this stuff too, but if you could tell everyone your contact information, the best place to reach you.
Sure. Again, I'm Kimberly Mann. My email address is kmann@schulmanrogers.com. My phone number, 301-231-0957.
Awesome. Thanks again, Kim. Appreciate it.
Thank you. Bye,
Thanks
Chris.
for being on. Have a good one.
Take care.